Welcome to Money Matters with financial advisor Russ Story of Story Wealth Management Group. With over 20 years of advising clients, Russ has some ideas to share with you based on biblical principles, financial strategies from a Christian perspective. It all starts now. Here's your host, Russ Story.
This is Russ Story with Money Matters. I'm your host for Money Matters. My name is Russ Story. I am president of Story Wealth Management Group. We are a financial planning firm. So we sit down with clients every day, pretty much every week. We have been doing this for about 25 years. And some of the things that we talk about on our show here on Money Matters, these are issues and topics and concerns and problems that have come about after talking to folks for the last 25 years. So hopefully this program will provide you with some information that can help you, your family, maybe your parents, whomever. But we appreciate you tuning in and listening and being with us today. So first of all, I just want to talk a little bit about some things that we're going to talk about today. We're going to talk a little bit about the markets and the economy. I hadn't done a general overview of kind of the way I see things and what's going on. I want to talk a little bit about portfolio rebalancing. And is that important? My financial advisor talks to me about portfolio rebalancing, and is that important right now? I want to talk about Mr. Tony Robbins. You know, he's been the fitness and positive mental attitude guru, and now he's kind of switching over and he's giving some financial advice, but don't know that it's all bad. So we're going to talk about that as well here on today's program. We may get into some reasons why we go broke during retirement, depending on how time sets up here. And depends on how we come out time-wise. A couple of announcements. First of all, we on the 13th, we're having a webinar. We're going to talk about the SWAN strategy portfolio. We're going to talk about managing risk, and here's one of the strategies that these guys have put together that has a pretty impressive historical track record. One of the things I'm concerned about, and I think you should be concerned about as well, as this bull market gets long in the tooth, things have a tendency to cycle around. You know, we had a day last week, the market was down 350, 360 points, and kind of got things rattled a little bit. Things kind of grabbed, they kind of came around and rallied in the next day or so, but obviously, we're seeing some more volatility in the market, and I think that's a sign for us to make sure that we have a strategy in place. I'd encourage you, if you talk to your financial advisor and they say, well, you just hang on, it'll go through ups and downs, but I think there's a better way. One of the things that we advocate at Story Wealth Management, our strategy, we glean this from a lot of different research resources. We believe you should buy, you should hold, and you should sell. So for more of that, I'd encourage you to sign up for one of our seminars. You can go online and send us an email. We're going to be in quite a few cities and towns here in the near future. This summer we'll be in Perry, Florida. We'll be in Tallahassee, Florida. We'll be over on St. Simon's Island, Georgia. We'll be in Tifton. We'll be in Douglas, just to name a few. So if you would like to come and be with us, one of the things we do, we give away cookies. We provide refreshments. Our chocolate chip cookies are out of this world. So come be with us and have a cookie. And, if you don't get anything out of the workshop, hopefully we've both made a friend. So I'd encourage you to take a little time and come out and be with us. We talk about an awful lot of things during those seminars, and we cover a lot of ground. And what we find is that we're covering things that a lot of people are concerned about. I want to talk a little bit about the economy here for a minute. One of the things that's sort of on our radar here, we look at inflation, and we see that based on the numbers that we have faster wage increases. That can cause interest rates to rise, and that's something that we see in the future. We believe that your investment portfolio needs to be adjusted, if it hadn't already been adjusted, to to thrive in this different environment, this different market environment. We know now, we have a fairly clear picture of where Trump and his economic plan's going. It's going toward deregulation. It's going toward reducing a lot of the government expenses and entitlement programs, and it's fairly clear the way he's putting things in place. We still don't know how things are going to go with this health care program in total. We know there's been an attempt to make some changes, and those attempts didn't go over very well politically, and in Congress they shot some of them down. But we continue to overweight in U.S. growth and dividend equities, and we underweight in bonds. If that's, I'm speaking very generally now. Another thing that we're looking at, we're trying to be sure that from an asset allocation standpoint, we're paying enough attention to alternative investments, which typically can be seen as bond alternatives, because in a rising interest rate environment, to get any yield on a bond, you have to go out a pretty long way on maturity, and we don't believe that that's very smart right now in a rising interest rate environment. IMF forecasts global GDP, that's gross domestic product globally, will pick up to about 3.4%. I hadn't done that yet. 3.1 is what it registered in 2016, and this will be the first time growth has been above the 20-year average since 2011. A lot of business surveys go into this to determine this. And we think the biggest risk to stronger global growth in 2017 is going to be the threat of trade wars and calls for protectionism, European political upheavals. We saw Great Britain just vote to remove itself from the European Union. So with global trade is an important driver to global GDP. Changes among just a few countries can have a fairly noticeable impact on global growth and corporate profits. So, our expected returns over the next 12 months, well, we think U.S. equities should give us somewhere between 6 and 8%. This is our opinion. We think emerging markets somewhere between 7 and 8%. I think dividend income somewhere 5 to 6%. High yield municipals should be okay as the economy expands. Hopefully improved credit quality will help to offset any interest rate increases. Now, Chairwoman Yellen reiterates the Fed's plans to raise funds. She said they're going to do it 2 or 3 times in the next year. Currently, the Fed funds rate is 0.625. She's not specific on when this rate increase is going to occur, but she's saying get ready. Well, we expect the last 2 increases to be maybe a third hike this year, and we think the Fed will be between 1 and 1.5 by the end of the year. So interest rates increases are important, but we believe the impact of real economic activity in 2017 won't cause GDP to slow. We think the impact in 2018 will be more important to assess later in the year. So for next year, what's our outlook for U.S. equities? Well, we think that the bull market will continue through 2017. Maybe we'll get a 6 to 8% total return. This new administration's tax cut plan and their other fiscal proposals are designed to drive more cash into business and consumer pockets. That should enhance economic activity if spent and invested, and we believe stronger economic activity is positive for stocks over bonds. There's a few things that are concerned. Delays in implementation. One of the things that we see is politically, our President Donald Trump is totally under fire right now. And I believe it's indirectly a response to his more aggressive economic policies. And a lot of people don't like what he's doing and the way he's doing it. They're more globalist, and he's focusing more on the U.S. manufacturing, U.S. workers, and policy as it may benefit the United States, and not at the expense of the global economy overall. So we are here. We've talked a little bit about where we think things are going, maybe where they are. We don't know. One of the things for sure, I talk about these estimated, projected our forecast for different types of investments. over the next year, couple of years. But the reality is we have to hope for the best, but prepare for the worst. Well, we're going to talk a little bit about that in just a minute. We're going to talk about ways to rebalance and protect your portfolio over time and some tried and true strategies that have worked. We're going to share those with you in just a second. Right now, we're going to listen to a message from our sponsor.
You're listening to Money Matters with financial advisor Russ Story of Story Wealth Management Group, where their purpose is to help guide clients in making the right decisions for their financial future. Russ Story began investing in the stock market through a class in high school over 30 years ago. He spent several years in Atlanta as a vice president with Buckhead Financial Corporation, and now he operates the Story Wealth Management Group based out of Douglas, Georgia. He has lectured at the University of Georgia on issues of retirement planning and financial issues and taught investment classes at South Georgia State College. His titles and designations include financial advisor, registered financial consultant, and investment advisor representative. For more information, remember this website, storywealth.com. That's storywealth.com. And now for part 2 of Money Matters, here's your host, Russ Story.
This is Russ Story back with you, Money Matters. I am president of Story Wealth Management Group. You can get in touch with us at storywealth.com. Find us there on your computer. You can also send me an email, rstory@storywealth.com. We have been getting an awful lot of emails from folks who are interested in different issues, want me to talk about different subjects. One of the ones actually 2 weeks ago was about rebalancing, and I'm getting around to talking a little bit about that. One of the things we advocate, we talk to our clients about rebalancing and how important that can be. We talked about different ways to help protect your investments in the event of a market downturn. You know, I said this last week, and I continue to harp on this. One of the things that my clients and folks around don't want to talk about, don't want to think about, the market going down. They don't want to talk about the risk of the market and what can happen when the markets go down. Let's talk a little bit about history, and let's talk about it in a historical perspective. If you invested money in 1929, going forward, every 3.5 years you've had a market downturn that's reduced your account drawdown of about 35%. That's been the average drawdown since 1929. Since 1929, we have a bear market as defined by a 35% drawdown from the high. That's the way I define it. Then every 3.5 years. Now, every 3.5 years, we have a drawdown of 35% on average. Now, this is tremendous volatility, really, in the real world, and this can affect you as an investor very dramatically. Now, if you're 30 years old and you're putting money into your 401k, the market does have a tendency to recover. It always has over time. So what's the big worry, Russ? Well, the big worry is as you become closer to retirement, your volatility, you being exposed to volatility can have a dramatic impact on your ability to use that pool of capital and to draw an income from. And what we try to do is make sure that we're doing everything that we can to allow you to make hay while the sun shines. In other words, to make money while money's being made. If you're in the stock market, great. But we want to have a strategy in place to protect you in the event of that historical 35% down mark. And you say, well, golly day, Russ, don't folks have kind of that figured out? I mean, I listen to CNBC and they say this and they say that. Well, the reality is these guys are selling airtime, okay? And you have to kind of keep it in perspective. If you don't like what they say on CNBC today, just stay tuned because they'll say what you like tomorrow. Because these are opinions, these are talking heads, these are guys who probably really and truly aren't sitting across from people, men, women, children, grandmothers, moms and dads, children of parents. I deal with these folks every day. So my perspective may be a little bit different than a guy sitting in an ivory tower in New York talking about his theoretical economic theories. And the reality is what we have to do as investors is protect ourselves and grab the bull by the horns. Because right now, nobody wants to talk about risk. Nobody wants to talk about the market going down. I'd encourage you, sit down and ask your financial advisor what strategy you have in place to protect yourself in the event of this down market. If I told you every 3.5 years the market goes down, and then I said it's been 7 years since the market's had that decline, you'd say, boy, from a historical perspective, we're certainly due for a pullback. If I said it's been 9 years, you would say, wow, it's almost 3 times the amount of time that's gone by for the market to go up without that pullback we have usually. And I go, exactly. So it's been over 9 years since we've had that pullback. And I think that as the market gets long in the tooth, yes, we have some favorable wind. We have, it seems, the move of the government to try and put more money in the pockets of American men and women, and that's all good. But at the end of the day, there are geopolitical issues that we can't see. There are things to derail those politically that we can't see. And I think you can really look and see where politically there's a move afoot in this country to do everything they can, media included, to try to stop this pullback in regulation, this pullback in taxation, and I think there's a huge move to do everything that they can to keep this from happening. So, a couple of things I want to mention. Let's talk about risk management. One of the things that we do is we believe in building a firewall whenever possible. One of the things we like to do, and there's different hedge strategies that are available. So we make money when the markets continue to go up, but it's sort of like a ratchet wrench. It only goes so one way, and if the market pulls back, then we don't lose what we made during the year. And there are strategies for this. Used to 15 years ago when I did this, we didn't have some of the tools that we have available today. But one of the things that we can do is to try and make sure that our portfolio is rebalanced. Now, this is one of the first tiers of risk management that I would argue that we can put in place. A lot of times we hear this drumbeat for picking the right investments and minimizing costs, but it can drown out the maintenance aspect of having a portfolio rebalanced. That doesn't seem really sexy, does it? I mean, it's just something, but it's some maintenance there that needs to occur. Financial advisors don't all agree on when they should rebalance a client's portfolio, but most do agree that it's important to remember why people bother to do it in the first place. Well, rebalancing can be a good thing if it's done to get investors back to their optimal asset allocation. Okay, so in terms of rebalancing your investment account, your portfolio, it's how you divvy up stocks, bonds, alternatives, different investments, cash. If it gets it back in line with the mix you determined that made sense for you when you set it up, then that's good. Let's say, for simplicity's sake, 60% in stocks, 40% in bonds and alternatives. It's a strong equity market that leads to growth. The stock position, if you never rebalance it, you could have a ratio over time of 90-10 or something. And the problem with that is that stock-heavy portfolios come with more risk. Let me say that one more time. A stock-laden portfolio, if it grows itself, I don't want to undo that, man, because it's doing well. We want to let the horses run, and we need to manage risk. And if you can handle huge volatility, then that's one way to look at it. But if you can't, then you need to try and minimize as much downside as possible. If you have a high risk tolerance and you can stomach volatility, maybe the length of time that you need your money, then stock heavy portfolios might not be so bad. But if you're a long-term investor, you can handle it, then you're in the accumulation phase, then I believe rebalancing is maybe less important. That's my personal opinion. However, I do believe that as you get closer to retirement, as the magnitude of your wealth increases in your 401k, retirement programs, savings accounts, rebalancing makes more and more sense. It becomes more and more important. So whether you're rebalancing at the asset allocation level or actually within a particular asset class, you get another benefit. You're profiting off gains from outperforming investments, and you're paying lower prices for underperforming ones. So, we've always been taught to buy low and sell high. Well, the other part of that is sell high and buy low. And when you rebalance, what are you doing? You're doing exactly that. You're selling high and you're buying low. And it's a discipline, it's a system in which will help you over time, we believe. You say, well, so when do you do it? Well, I've heard this said in a meeting once that, how often do you advocate rebalancing? Well, I can tell you that we have a software program where we go in and analyze a client's situation, their investments, their time horizons, and it'll actually give me an optimum time historically for that client to, it may be every year and a half, it may be every 2.5 years, it may be 3, it may be every year, but it gives me an optimal time to rebalance, and of course it gives me an alert as when to do that. If you're on a diet, do you step on the scale every hour? And I thought that was kind of funny, but you don't. You let your investments run. You set a strategy in place. You rebalance, I believe, at a particular time based on analysis to give us an idea of what's going to give us the most benefit, and then you go from there. If you rebalance too frequently, the potential for trading fees can cut into earnings. You don't want to do that. You could be shooting yourself in the foot, I think. But another potential expense that comes with rebalancing could be taxes in a taxable account. Now, if you sell investments for a profit, you may pay some tax on capital gains. In a 401k, it doesn't matter because you're not taxed on gains. It's tax sheltered. In an IRA, it doesn't matter because it's tax sheltered in an IRA. So you should feel free to rebalance when the optimum time comes into being, and you should always try to manage risk as best you can. We have some strategies. One of the things we're going to talk about, webinar coming up on the 13th of next month. I think you'll begin to see how serious I am about protecting somebody's portfolio when you see the level of sophistication and the track record that this Swan portfolio has provided for investors. I'm very excited about that. Also, the Levi Rudd blood drive we're having on the 16th. We'll have the big red blood mobile sitting outside of our office here in Douglas on the 16th. I'd encourage you to give us a call and make a reservation. We're going to have some pretty neat refreshments. We're going to have T-shirts. So we're going to have a fun day, a fun time, and this is a way for you to give back. It's a very important and worthy cause. It's a way for you to help your fellow man. We don't often have situations like this when you think about it. This is a way to give back and to help out. Also, the seminars. As I said earlier, we're going to have seminars in several different towns: Perry, Florida, Tifton, Georgia, Douglas, St. Simons. Just to name a few, and we'd encourage you to send us an email if one of those places you think will work for you. Again, my name's Russ Story. Our website, storywealth.com. Go in there and look around. It's troll it, as my daughter says. It's trolling my Facebook. No, I'm trying to see what you're up to. I'm your parent, so troll our website, okay? And send me an email if you're so inclined. rstory@storywealth.com. I'd love to hear from you. You can give us a call. Call us at 912-384-0030. And again, we would love to hear from you. Now, last but not least, I'm going to hit this quickly. Best-selling author Tony Robbins. You remember him? He was a big, tall guy that talked about having a positive attitude. He talks about some problems. He was quoted recently. He said there's a move toward increased disclosure, and he thinks that really hadn't solved the problem. He's saying people have hidden fees in their retirement plans, and it's confusing and a major problem for retirement savers. He says in 30 years, the industry didn't even have to tell investors what they were charging, said Robbins, who is also a partner and board member of America's Best 401k, Chief Investment Psychology for Creative Planning, whatever that is. A few years ago, the law changed. Well, it's been a little longer than a few years there, Tony, but anyway, I get where you're going. He said now you get a 35 to 50-page disclosure document that if you're a lawyer or have a degree in finance, maybe you can understand. But here are the top 10 places to retire overseas. Anyway, I thought that was kind of interesting. When you ask people about their investment account, it's funny. It's not funny because it means that we're not informed properly. When folks were asked what they were paying for their retirement account, 72% in a poll said they were paying nothing. Obviously, that's not true. So Robbins noted that even small differences in a fee percentage can have a big impact on somebody's nest egg. Cutting fees by 1%, he explained, can make your money last 10 additional years in retirement. According to Robbins, hidden fees and various backdoor payments are costing Americans billions of dollars a year and can reduce an investor's overall retirement savings as much as 40% to 60%. He's urging people to take control of their finances to make sure they are aware of fees associated with their qualified retirement plans and better manage their 401ks. Well, one of the things that I can say that I think is encouraging, Mr. Robbins, the investment industry over the last 35 years, I've been in this doing what I'm doing for about 25, has done an incredible job at reducing fees and cost. Now, one of the things that I want to make clear to my clients, I want them to understand what I charge and how much the cost is for investment management or whatever. That's something that I think is very academic, and I think it's very important. I find that the more my clients understand about what I do, how I get paid, it seems the happier my clients are. I think they should be because they should be more comfortable. So anyway, if disclosure is a question, if you're not sure about your financial advisor and how they charge what they charge, if you think they're working for free, then we need to talk. Anyway, give us a call. Our phone number is 912-384-0030. We'd love to hear from you. Make an appointment with us. Remember, the webinar's coming up, the one on Swan coming up on the 13th. Remember the 16th, our blood drive. And, go in there, and if you're in Tallahassee, Florida, sign up for our seminar. If the sign-up sheet isn't there already, because I know they've been working on our website a little bit, just send us an email. It's easy to do, and say, hey, I live in Monticello, Florida, and I'd like to sign up for one of your workshops, Russ. So, and we'll make sure we put your name in the pot. We'll reserve a place for you, and that'd be good. I'm your host, Russ Story. I'm your host for Money Matters. It's always a pleasure to be with you. I hope you have a wonderful weekend. I hope you have a safe weekend and some money to spend. And have a good week. We'll talk to you later. God bless.
And that's another edition of Money Matters with financial advisor Russ Story of Story Wealth Management Group. Find more information on this website, storywealth.com. That's storywealth.com. Feel free to email your questions and comments to Russ at this email address, rstory@storywealth.com. The email, rstory@storywealth.com. And finally, here's the phone number to call right into the office of Story Wealth Management Group, 912-384-0030. That's 912-384-0030. Story Wealth Management Group is an independent firm with securities offered through Summit Brokerage Services Incorporated, member FINRA SIPC. Advisory services offered through Summit Financial Group Incorporated, a registered investment advisor. Investing involves risk, as you may incur a profit or a loss. Please carefully consider investment objectives, risk, charges, and expenses before investing. Past performance cannot guarantee future results. Summit Brokerage Services, LLC, and Story Wealth Management Group do not provide legal or tax advice. For services of legal or tax advice, please seek the services of a qualified professional. Be sure to join us next Friday.